Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, and I'll be filling in for Keith this week. Now, often in Market Outlook, we like to go into a little bit more detail and maybe even off on a interesting and relevant tangent in terms of information that might drive what is going to happen in the market in the coming week. And that's all great. But this week, I'm going to do something a little different. Because we're working on this program that's focused on putting together what we're going to call the trading essentials, the core of what we think a trader can focus on to basically get 80% of the functionality, maybe 90% of the functionality with 10% or 20% of the work required. In other words, it's like a shortcut without cutting out really important stuff. So as kind of a test of this, I'm going to try and take that same approach to Market Outlook this week. What I'm going to do is give you a really concise way to break down the markets. And not only that, at the end, you'll find out that all the information that I'm presenting in charts is something you can get absolutely for free. So it's a little bit different this week, but I think you're going to like it. Now, before I get started, I just want to make sure if you're just stumbling on us on our YouTube channel, make sure you subscribe. And also, you can follow us at Market Gauge and at Market Minute if you're a Twitter follower. And if you don't already know, you can find this and many other tutorials and trading ideas at marketgauge.com/tutorials. And finally, this video is in HD. So if it's not crystal clear, use the setting in the lower right hand corner of your chart to elect HD and blow the thing up into full screen. I think you'll like it much better. All right, so with that, let's get started. So the first part of the core essentials, the trading essentials that you should look at are the major market indexes. We do this every week, I know. We look at the SPY, the Qs, IWMs. I could put the Dow down here. I've got the TLT, so we're looking at interest rates. And I'm looking at them on a weekly basis. And really, all you need to do is look for major trends and major support and resistance levels at this step. All right? We don't need to overanalyze it. That's why I've got it scrunched up. Now, if you want a little bit more detail, this gray line happens to be the 200 week, the magenta line happens to be the 50 week, and that's really because, one, they work pretty well, right? If you look at how the markets follow them, that's the first test of a moving average. Do they respect it? And you can see in each of the markets, the 200 has worked really well. The 50 actually has worked really well. And then you want to look at where you are in terms of major support and resistance. So even without knowing what these levels are, I can draw this line here and I can see that my SPYs are relatively close to some important resistance. I can see that my IWMs broke down from an important level of support, but now they are right at a trend line that goes back all the way to 2009. They're also sitting relatively close to the 200. And the Qs, they're sitting right at some important support levels there. And then interest rates, which are kind of a secondary, so I'm going to come back to them later if I just stay with the core. So big picture here, we can see we're at some pretty critical levels in the market. Now, of course, we do want to zoom in, so I'll zoom in quickly so we can get a little bit closer sense of what's going on at these levels. And we can see on a weekly basis, we pierced that important level, held it the prior week, and then this last week we did something that is very common and important to look for, which is we retraced back into this bar, held at prior support levels, and now we closed, and we actually closed higher than the prior week. So that's a powerful potential reversal signal on a weekly basis in the SPYs. So we'll kind of look for the same thing, see if we've got a similar thing going on in the Qs. We'll zoom in on the Qs because that's at a relatively similar support level, right? This lots of lows there, matches this low here, and near this low here. Now I could move that bar down a little if I wanted to actually be on the lows, and I'd wind up with the same look. The important thing here is how has the market responded to this critical level and this level here? It took it out, and now it moved higher. And not only that, just like the SPYs, when it came down to test the range of the week before, it held nicely, closed above, although it would be nice if it could get higher above that prior week. So again, looks like we are trying to turn on a weekly basis in the Qs. Now the IWMs, remember, these were the weakest. I say they were the weakest because they broke down from this important support level that we've been talking about in those other markets. And now it sits on a trend line, which the other ones we can't say, that goes all the way back to 2009. Now the other thing to keep in mind with the IWMs is that you've got this support level down here. Now I know that's a long way away, but that becomes the next target if the markets break down from these levels, right? So the zoomed in picture is going to look like this. So while we can't say it broke the significant support and rallied back, right? Because that's up here. We can say that it broke the trend line, and now we want to see whether or not it continues lower or bounces up through that trend line. Now, it's tried to do that this week, hasn't done it completely. We'll want to see another couple of closes back over the trend line and really over the 200-week moving average. And if we get that, then this will look like a successful test of these lows. So the big picture here is that all these markets are testing some important support levels. However, if they break this support level, it becomes a very dangerous situation. And that's true in all of the markets. If I close this out, you'll see that, and go zoom back out. Again, this is just a big picture. We'll go to the daily. If the markets break down from these support levels, see this line here in the SPYs? That's going to be your next really major level. All right, so that would be a pretty significant drop to the downside. Not that it wouldn't, that it has to go straight there, but these are really big inflection levels. So that's the backdrop. So now let's go to the daily. So the daily is where you're going to do a little bit more detailed work in terms of identifying more specific price levels to watch out for, at least for most of us, on a trading basis. All right, so if I zoom in, and now we're looking at the 200 is still in gray, the 50 is, and these are simple, are in magenta, the green is a 10-day moving average. So this 10-day moving average is a really important level, especially in our core trading essentials approach to the market. And without going into too much detail, many of you have heard me go into this if you are a member of any of our services, but if you just look at the 10-day as a basic bias line, meaning if you're above it, you can be bullish. If you're below it, you can be bearish. And then you look for a little bit of confirmation. So in this case, if you're looking for a bottom or a potential bottom, what does it have to do? You want to see it come over the 10. In this case, we have nice consolidation once it starts to try and get over the 10. And then Friday, a nice explosive confirmation move higher. All right, so we could stop right there, really, and say that this is a market that has just tried to turn, and we can look at it as a recovering correction. And the next major resistance is up here around these price levels and this 50-day moving average, right? That's basically all you got to know. Now, when you get into a little bit more detail, you should expect that it might pull back at some point. It may be Monday. It certainly could happen this up and coming week. Where should you expect the support? Right on top of where it broke out from and wherever this 10-day moving average comes in. When do you know, or when do you expect that maybe this nice rally, which has been a pretty significant rally from these lows, if this turns out to be yet another bear market rally that rolls over and dies? Well, that happens when you get back under the 10 and confirm and move lower. So if you're a bear looking to resume the bear trend, then that's what you look for. If you're a bull looking to catch this low, then Friday was a really key day. Shallow pullbacks are a big opportunity, and you can trail your stops up under significant resistance levels as the market moves up. And then what we want to do is we want to look to see whether or not we have that same picture in the other indexes. And the Qs, not quite as convincing, right? Because we didn't break back over that first attempt to get over the 10-day moving average. So it wouldn't be surprising to see the Qs struggling here. However, if they break out, then they're right in the same camp as the S&Ps. So it's not that far off. All right, so it's basic levels can take you a long way. Where do we look for the next level of major resistance? Up here around the 200, the 50, they're going to be about at the same price. And not only that, they line up with these lows here. So that's going to be a really significant level, that 185, to look for. Now, we would also like, since the IWMs are the broadest measure of anything that we've looked at here, and they've been the weakest, we'd like to see some confirmation, or I should say participation, from IWMs as well. And in fact, we have that same pattern we saw in the SPYs. Nice consolidation after a big volume low, moves over the 10, consolidates, breaks out on Friday. Same story I just told about the S&Ps or the SPYs. Could pull back. Where are you going to look for support? Right in that breakout level, right at the 10-day moving average, are two good areas. Where are you going to look for resistance? This is the same level we were looking at on the weekly. That's going to be a really big level up there, which is about 107. Let's call it 107 even, whatever these lows are. All right, pretty straightforward. So if I sum all that up, we basically see a market that looks like it's just tried to turn. We have some pretty clear ways to identify when that turn has potentially failed, and where you could buy it on pullbacks, and where you should look for it to have some trouble in terms of resistance. So the next thing that you want to look at, as we do every week in Market Outlook, is what's the internal situation of the market. Now, here too, there are many different indicators that you can look at. I've boiled it down, and we're going to boil it down this week anyway, into 6 different charts. Now, you should recognize most of these charts. Mine are here are perhaps formatted a little differently than Keith has them on his machines, but here's what I'm going to look at. I'm going to look at market breadth as told by up-down volume, advances, declines, and the McClellan. And I'm going to look at it for the New York Exchange and the Nasdaq. Then I'm going to look at how the new highs, new lows look, New York and Nasdaq. And then I'm going to look at sentiment. And I'm going to do that by looking at 2 measures of the VIX. So that's it. But let's go ahead and do it. So here's the SPY. Now, the way we have this set up is the McClellan oscillator is right in the middle. So I'm going to start with that one. Now, the darker blue lines on this chart are your main lines, okay? Those are your main overbought and oversold levels. The middle here is dotted at the 0 line because one of the ways to look at the McClellan oscillator is to consider it as a kind of a bullish market internal measure if you're over that 0 line. But when you roll over after going above this 150 line, it can become an overbought measure. And there's another level up here, the 250 level, which you can kind of see sometimes in the legend, depending on where the last price is, minus 250, positive 250. If you get all the way up there, then you're getting pretty oversold. And if it rolls over up there in conjunction with negative price action, and that's really important, because right now, when after the market has gotten oversold as it did in here, right, and turned up, and now the price action is finally confirming that oversold is now coming back into positive, and this is another reason that we would expect that we might get up to that resistance level. So when you come from a strongly oversold level, it's actually a bullish indication when you immediately get into overbought. So when you have a situation like this, you will find, much like we did over here, that when you get up to oversold and start working it off, if you don't have any really negative price action up here, you can continue to move significantly higher. All right. So it got overbought. It's actually bullish, in my opinion, after you've gotten so deeply oversold. Not necessarily right here, but you're still recovering from this low here. All right. Now, negative price action. If it gets back to this 10-day moving average, we never took out the 10-day moving average all the way up to the highs. All right. Really straightforward. McClellan's kind of confirming which way we're going to move. So what do we look for with the McClellan here? Well, we will look to see if it comes oversold, but as long as the markets hold above their 10-day moving average, I wouldn't get too panicked about the McClellan. Now, the top of this chart is the up-down volume ratio, and that's going to be a shorter measure in a similar way as the McClellan. You can see that got oversold here. It's turned up. And in this case, we want to see this just to measure the internal health of the market. Would like to see this get overbought as well. But essentially, when you look at these three charts all together, you want to see them doing all the same thing. And in this case, it's coming off a bottom nicely, working its way up, hasn't gotten overbought on the short term, which means we do have some more room for it to go up. If this thing gets overbought, it might pause. It might cause the market to pause a little bit before it moves higher again. Now, down at the bottom, this is kind of an intermediate term measure of advances and declines. So McClellan will have a much longer term measure. The up-down volume is a shorter term measure, and the 10-day here be kind of an intermediate term measure. Again, this one confirms the fact that the markets did get significantly oversold down here near the bottom, which is always a good thing if you're looking for an opportunity to buy a snapback rally. And it's back above its oversold levels, which we like to see, back above the minus 4,000 level, and headed higher. All right. So next thing we'd look out for this would be if it gets too overbought, which would be over this 4,000 level, or even more overbought over the 8,000 level, right? So if all these measures start to top out right at resistance, and then the market starts to roll over, this is going to be more likely a couple weeks away. Then you'd be watching out for a turn at the top. All right. Now, take that same approach and look at the Nasdaq. And to make a long story short, everything I just said about the New York exchange is true over here at Nasdaq. Now, in this case, I'm looking at the Comp X, which is the broader measure of Nasdaq. So you can see that the support levels are a little different than we saw in the Qs, but right down at the support levels, all three got oversold. All three have now turned up. None of them are overbought yet. So this thing is in a pretty good and early position to potentially move higher. And we've already talked about the levels that we would look at to come to the conclusion that it's no longer moving higher. So that's your market breadth in terms of advanced declines as measured by McClellan oscillator. McClellan puts advanced declines together in just a different way than the 10-day sum, or in the case of the top chart, we're also looking at volume. So the next way to measure market breadth is new highs and new lows. And so here too is a chart that you've seen before. On the right, I've got New York. On the left, I've got the Nasdaq. In this case, I've got the Qs up here to give you a little different view than the Comp X, but same idea. So let's start with New York. So what do we want to see in the new high, new low? Well, the minus 30 level is under that you are bearish. When you get to the minus 20 level, you are really bearish. When you get back through the 30 level, you now can say it looks like we may have bottomed. The other way to look at this indicator is through trend, and if the trend is moving higher, then you can consider the market potentially looking to move up. Now, these are always confirming indicators, right? So just because this is turned up doesn't mean the market has to go up. You want to let the price action dictate. So in this case, the price action is positive. If we can get back over 30 here, we would be in a situation where it may look like the new high, new low ratio has bottomed out and could move higher. So this would be a good example of going from under the 20 to over the 30 and then moving higher. Now there's another thing in this indicator that you really want to look for, and that is down below you have the number of new highs and the number of new lows, the absolute number, as opposed to this indicator, which is a 10-day new high, new low ratio. So you take the total number of new highs and you divide that by the total number of highs and lows, and that's how, and you take a 10-day average of that to smooth it out, and that's this number. Right? So in other words, how many new highs are you making relative to the total number of stocks that are making highs or lows? That's not the same as just keeping the pulse of how many new highs or new lows are being made. And this chart is a really good example of that. All right, so if you take a look at the measure down here, it's essentially as washed out as we are down here, right? But down here, look at how many, the absolute number of new lows that were hit. So this is a much more severely beaten down market than it was over here. So that's why this is important. And as a rule of thumb, we've got the minus 100 line at blue and the plus 100 line in blue here. And so if you want to know a market that is likely to continue trending in a direction, your absolute numbers are going to be beyond the 100 level. All right, so in this case, if we look back here, this turned up and was doing everything that it should have been doing. But what wasn't happening is the total number of new highs really didn't balloon up. It didn't really balloon over that 10-day level, right? So you want to see something like you see over here. Now, in this case, the market didn't continue to move higher, but this was still a much healthier market over here than it was over here. And so maybe I shouldn't say it wasn't, maybe I shouldn't make this so negative, because the truth is that over here, the market did at least go sideways to work its way up a little bit, whereas over here, as soon as the market got weak, what happened? It collapsed. All right, so these numbers are not hard. You just kind of have to know what to look for. So you want something that expands out of this plus or minus 100. You want the trend to be going your way, or the way the price action. And you want to look for scenarios where the market comes from below the 20 and the 30 to above it. Or on the flip side, this is the 70 line, which you can see here, and the 85 line, and you can see that here. And it's just the same thing. If you come up over the 70 and then back down through it, that's not what you want to see. Even worse would be if you get up over the 85, now you're really bullish, which we never got to. But then if you fall under the 70 level, that's negative. All right, so that did in fact happen over here, and the market, or the indicator, continued to trend lower. The market managed to hold up, but it didn't go anywhere, did it? Right? So looking back over here and seeing this working its way lower would have been a negative drag on a market that you might have been thinking, hey, this thing might break out. All right, so that's how you look at this indicator, and we look at it now, and we see that neither the bottom line, the absolute levels of new highs or new lows, have really flagged anything great. The ratio has turned up, so that's a positive, but we really want to see it come up over the 30 to give this turn up more of a stamp of approval. All right, again, pretty straightforward, and we just take a look at the same idea here with the Nasdaq, and again, the picture is really similar, slightly different in the sense that the new high, new low ratio is well below its 20 level, so it's going to take a little longer to get back up to here. And the other thing I'll note is if I scrunch this down, it's been a long time since we've seen this number of new lows at one time. Total number here, it's down here around 800. In fact, I think it was 930 if I remember the number correctly. And we haven't seen that number of new lows since the bottom. All right, so this is back 800s, 900s in here. So not since the bottom in '08 have we seen that many new lows in one day. So that was a pretty ugly day. Now in '08 we had many of those days, so this whole thing is not quite as bearish as '08. But just to give you some perspective, that was pretty washed out down there. So another reason to believe that even if we don't go to all the way up to new highs, this market sure does deserve a breather in the market breadth category. So now let's take a look at the market sentiment. We do that with VIX. We got two different measures of the VIX. And the first one over here, we're just looking at the VIX, which is this red line, and looking at how it's trading within its Bollinger Bands, which are set to 2.2, basically 2 standard deviations. And as long as the VIX isn't at an extreme, then it's not too much that you have to worry about. So in this case, we're measuring the trend. We don't want to. You don't want to see the VIX. I shouldn't say you don't want to see it. You want to see the trend that it's moving in. But in this case, it's both the trend and the extreme, with the extreme being the most important thing to look for. So when you get an extreme, the way you want to look at this is when you get an extreme, you want to see the extreme, and then you want to see it come back inside. So just an extreme by itself is not enough. So if you look at this here, would have been extreme. That's okay. You don't pick a bottom yet. Still extreme. Still extreme. And so not until it comes back in and starts to head back in the other direction do you start anticipating that maybe that extreme is over. All right. Now this is not always going to pick the low as well as it did there. As you can see here, didn't get nearly to the same extreme, and while it may have indicated that it was a little overdone in the very short term, we still made another leg down and another push up, although it did not get quite as extreme. So VIX really here didn't reach an extreme where you could say, all right, that's it. But you can see now that as the market was consolidating, VIX was moving down. All right, so moving down is telling you the market's a little bit more confident as opposed to panicked, and that actually plays into what you'd want to see when the price action actually confirms it. Flip side will be if the VIX gets down under the bottom Bollinger Band, could indicate that it's just a little too complacent. So another way to measure that complacency with VIX is to look at the relationship between the short-term VIX measurement and an intermediate-term VIX measurement. And so that's what we do with the VIX-VXV ratio. Then we take 3 different moving averages of it just to be able to smooth out the data, as well as give you more of a confirmation that the overbought or oversold, or I should say over optimistic or overly pessimistic views that are out there have reached an extreme. So the longer the moving average, the more evident that extreme would be. So the green, you can kind of tell by which one moves the slowest. The green one, which moves the slowest, is the longest one, about 5 days. And so here too, here again, we have 2 different levels. We have a basic level of too much optimism, basic level, and you can see on the sidebar where these are, 1.2 and 1, too much optimism, too much pessimism, and then you have the extreme levels, all right, that are above that. And this is really simple to read, just like the Bollinger Bands. I just talked about. You want to see these moving averages get over the level, and then you want to see them come back into that level. And then you want to see corresponding price action, right? We're always looking at price action. So if the price action comes back down at the same time this is coming back down, then that's confirmation that what once was a really optimistic market may be pulling in. All right. So where does that leave us here? Well, this indicator confirmed the fact that, in fact, VIX did get a little bit too bearish and now started turning up, and the market's turning up with it. That's what we want to see, right? In the same way, just a few weeks ago at the end of the year, the market was a little too optimistic, even though it wasn't evident in the price action. But here's a great example of price action starts to fall apart. It's actually falling apart from a situation where people were pretty optimistic, which means a lot of people are on the wrong side of the trade, and you wind up getting a sell-off. Can't guarantee you're always going to get a sell-off like that, but that's exactly what we're looking to do. All right, so that's it. 6 charts, and really you've got 4 of those charts are shared between New York and Nasdaq. So you can do this a lot quicker than it actually took me to explain it. All right, and the cool part about this is, as I said in the beginning of this, you can find all these charts now on our website absolutely for free. So they're right here in the resources area, a little big view. All right, so you go to little big view, you'll wind up on a page that probably would put you over here at market overview, and the charts I just went through are right here at market internals. All right, if I click on here, you'll see the first chart that we looked at, the SPYs and the McClellan. If you click on the chart, it'll get bigger. Click on it to make it smaller, and if you're wondering how to interpret it, you'll find a description of roughly how to interpret it, what all the key measures are, and you can even click on this, get a detailed description of what the key measures are, and a little bit more history. Click on this, you'll get the big chart that'll show you how it's done over longer periods of time. All right, and you can find that on every one of the charts, and you can click next chart, next chart, next chart. Go through these same 6 charts all by yourself. All right, so hope that helps. Hope you find your way over to Little Big View during the week, so you don't have to wait till the end of the week for us to tell you all this. And with that, I'm going to go back to the TLTs for a little bit more detail on what's going on with the market. All right, so remember when we were back at this chart looking at the overall market indexes, and I said I'd come back to the TLTs. And the reason that I wanted to come back to the TLTs is, let's just go back to the weekly for a second. So the TLTs are the longer term interest rates, 20-year bonds. They're not 30-year, but 20-year. These things are at a really critical level here. And the reason that this is important is because with the Fed just a month ago deciding to begin a process of raising rates, it has been a common perception, a common feeling that rates should have the pressure of going up. Now, this is a little easier to debate now after the Bank of Japan on Friday pushed its rates negative. So now you've got European central banks saying that they're going to do everything they can do to pump liquidity into the system, which will be a negative, which will push interest rates lower. You've got Bank of Japan saying they want to push rates lower. In fact, so much so that they're saying they're going to make some of them negative. And you've got the U.S. that is on this, or at least began this campaign of doing the opposite. So which way are rates really going to go? They're going to go to whatever direction the market decides they're going to go. And the TLTs is a great way to figure out really who's winning that battle. And it happens that battle is at a really pivotal area in the charts. So this is a weekly chart, and one of the things I do with my charts, which I've just started to do in the last year or so, is rather than just draw horizontal lines, which most platforms will do, I use a trend line. The difference is the horizontal line goes all the way back to the left. By using a trend line, I can put that trend line, even though it's not a trend line, it's a horizontal line, I can put it all the way back to the most relevant point. So this makes it really easy for me to look at, say, this line and say, well, how far back is that level's relevance? And it turns out I can just keep looking left until it stops. And then I know what I'm thinking. If I come back to this a week from now, I'll know exactly what I was thinking. Oh, this is relevant all the way back to 2012. So when I look at this line, I think, all right, I see this is relevant all the way back to the middle of 2015, right? It's different. So that's something to think about when you draw your own lines. Either way, the chart remains the same, which is we have on the recent consolidation, we are at a critical level, and I'm going to show you where that line really comes from on the daily chart. And on a long-term basis, we are at an amazingly critical level because we hit it last week. We pierced it but didn't close above it this week. This is when I say this week, the middle of 2015. And this is where the market basically collapsed from after peaking out, right? So it peaks out, sells off hard, tries to recover, which, by the way, I should have another line here, tries to recover, and then made the move that would have been viewed, may still ultimately be viewed, as kind of the confirmation that this was the high in bonds. Generational high so far. We're back challenging that level. That means the market really has some big potential to move big from this general area in either direction. So if it's going to move big from the perspective of moving up, what does that look like, and why might I think that that could be the case? Well, take a look at how I've drawn these lines here. First of all, this again, 50-week moving average, which has demonstrated the market really respects it. 200-week moving average. So we pulled back to the 200-day moving average, week moving average, bounced, retraced, checked, held. Now we're moving back up. If you take a really broad view of this, bonds from a channel perspective, so this channel is a valid trend line right here. Take that valid trend line, make a parallel, put it to, in this case, I put it to the closing high on the opposite side of the two trend line points, and there's your channel. So even if we just stay within this well-defined channel moving higher, over the next couple weeks, it wouldn't be unreasonable to see this thing significantly higher, over 130. Right? Now, when we get there, if we get there, then we can assess it from there. But the point of this channel is that this is a pretty good description of how this market is trading. It happens to be, I don't even want to say stalled out. It happens to be challenging some really important weekly levels right here. So let's take a look at what these weekly levels look like on a daily basis. So on a more micro level, in terms of how you would trade this, here's the same channel. You're now looking at a 50-day and 200-day moving average, which you can see both very relevant, and the 200-day really not that much different than the 50-week. We now are in a bullish phase in the TLTs. It's trending and has not come back down below the 10-day moving average. This line, the line we were looking at before, happens to be, or at least should be, it's gotten moved. That is the closing high. This is the significance of this horizontal line. It's the closing high from back here. Oh, I know I moved it. because here's the close. Close just barely above it there. If I move it now as being the closing high of this move, Friday we took that out. All right, now it held in at last week's highs. But looking forward to this week, the key levels are really going to be this support in here if it pulls back, and then the lows that exist under the 10-day moving average. So this is an area that over the next several weeks we want to see how TLTs play out. If TLTs break out above this 128 level, they could really push higher. And until they break below this level, probably about the 125, let me get the number, 125.30 area, rounded off to 125, you got to see the TLTs as being in a pretty significant bullish trend to the upside. All right, now there's a couple reasons why TLTs might move higher. First would be that if the stocks begin to sell off, TLTs are perfectly poised to be to really blow up to the upside as a flight to safety. So if we get strong moves on the downside in stocks and strong move to the upside in bonds, pushes these higher. The other way that TLTs could be pushed higher is the way that they got pushed higher on Friday, which is central banks finally, shouldn't say finally because it has been reflected in these charts, but central banks putting enough pressure on the markets so that the markets believe that in fact rates will stay low. And the third way that this could happen is that a continued and even more intensified view by the markets that global growth is slowing, which would put more pressure on rates to go down, which is bonds going up. So those three forces are all working to push TLTs or interest rates lower, which is the same thing as bonds going higher. Right? There's a couple of there are scenarios there where stocks could continue to go higher. Stocks could continue to bounce if the belief that growth is slow but not recessionary continues, and that trickles into the feeling that rates are not going to go up and therefore stocks could continue to go higher. Not necessarily blast off, but they could continue to go higher. So it's really important to watch the TLT's direction relative to the stocks right now. They can both move higher if they likely do it in a gradual way. However, if there's a violent move down in stocks, TLTs could explode higher. Now, why might TLTs move lower? All right, TLTs might move lower if the perception of growth slowing switches to growth not slowing as badly as we thought it is, or as the market currently perceives it to be, in which case TLTs could collapse, or I should say TLTs could sell off hard and stocks could go up. So those are the relationships you want to be looking for. What are TLTs doing? What are stocks doing? And why? And how violently? If you keep your thumb or keep the pulse of the market that way, you'll really have a better idea of whether or not the day's move is likely to turn into the week's move, is likely to turn into the month's move. All right? So, all that said, I hope that helps, and we will see you in the next video.